We have three topics for you today. First of all, we're going to talk about Amazon's addition to the DOW that's upcoming, replacing Walgreens Boots Alliance. So super excited about that since Amazon is one of our major holdings. Number 3 in the book right now. So I'll peel that back for you. We're also going to talk about one of our ego stocks. Remember, that's exponential growth opportunity stocks, and that's Sentinel 1. Now it's selling off hard today. We're going to talk about why and sometimes how it's not necessarily related directly to the company. And last, we're going to close with a little bit of a primer on market volatility. Every year, there's a certain point in the year where the market sells off, but that's not necessarily correlated to where the market ends up. So Mike's going to show you a chart which really kind of lays that out for you and kind of gives us insights as to how you can use that as an investment opportunity. So before we begin, though, remember this is a financial education presentation. You have to do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com. So let's get started with talking about Amazon. You know that I love Amazon. Here is the article that's popping up now. From CNBC.com. This article is kind of crapping all over Walgreens and why they fell out of the Dow. But really, my point is, why is Amazon being added? Well, when you think of the Dow, think of the Dow Jones Industrial Average, right? The 30 arguably biggest, not necessarily biggest, but the stalwarts of industry, if you will. So I would say when I think of stalwarts of industry, I do think Amazon and I don't think Walgreens. So I think it's a pretty good switch there. But the committee looks at several different things for choosing stocks for the Dow. We're not going to get into that today. It says unclear criteria. They have a committee. They determine these things, and they say that's pretty fuzzy, if you will. But it is a price-weighted average, which is of note to where it gets into this in the article a little bit. But here it is. The stock price of Walgreens has dropped from 60 down to 22, and there's no end in sight, right? Where you have Amazon's telling a little bit of another story, right? This is just a 1-year chart, moving up from less than 100 up to 170. So significant move up. But the Dow is a price-weighted sort of index, so the price does matter. Now, companies like Walmart just announced a 3-for-1 stock split. If you have an excellent memory I had to look it up because I don't, but the Amazon stock split, you're like, didn't Amazon just split? Yes, they did. They split in 2022, a 20-for-1 stock split. If you remember that, yeah, I was slapping high fives when they announced that. And of course, even after the 20-for-1 split, you're looking at this kind of performance. I mean, that's insane. Now, we all do know that technically a stock split is simply price management. The analogy that I use for folks is if I have a $20 bill and you have 4 5s, I can do a stock split to you, right? Give you the 20. I have now 4 5s. I don't have any more money. I just have 4 bills that priced at $5 instead of 1 bill at 20. So nobody makes money just because you split or do a reverse split of the stock. Now, however, there is a huge difference for a lot of folks, though, when a stock split makes the stock more affordable on paper, because now you can buy a share for a less amount. So it's like stock price bias or something like that that's being managed. So when I think, how does this relate to Amazon and the stock going forward being in the Dow? Well, once you're in the Dow, that gives you, a lot more exposure to people just buy the Dow and other things that are based off of the Dow. So are we going to see a huge move up today or when it gets finally added? No, but I think it gives a lot more strength to Amazon over time. But that's all kind of irrelevant to the strength of the company, and the strength of the company of these people. Remember, during COVID, they're the only ones that are out putting stuff at your front door. I couldn't be happier with having this in our book. And I kind of like to say that when we talk about our major holdings, what are the things you touch every day? Apple, right? It's in your hand for most of us, and several devices, as well as Amazon. If you're addicts like me, or I would say the family is, so it's probably not necessarily me. Might catch some heat for that comment, but we do have a lot of stuff coming to our door almost every day from Amazon, right? So couldn't be happier with the holding and couldn't be happier that it's going into the stock or into the Dow. All right, let's transition over to Sentinel One. I'll hand it off to Mike here to talk about why it's selling off today.
All right. Well, let me bring this up today. So with Sentinel One, and let me scroll down here. We love it when we can show you an ego stock and it is flying high and you can see that it's up 10%. But today I thought I'd bring up one that's down 10%, just down a little bit more than 10%, and that is Sentinel One. We still love this stock, still cybersecurity, AI powered. That's where we want to be. Interesting enough, as Steve says, we use Amazon or Apple every day. Companies need cybersecurity every day. They need electricity. They need the basics, which is why does this go down? The earnings didn't come out for Sentinel One, but they did come out for Palo Alto. And while Palo Alto announced that they hit their revenue, they hit their earnings, they guided lower for this year. And by guiding lower, their stock, I think the last time I looked, was down 26%. And they are an outstanding company as well, one of the top leaders there. So the question is, a Sentinel One, a Palo Alto, is when the market goes down like this, when it guides down and Sentinel One gets pulled down with Palo Alto, as well as CrowdStrike and a few others, is this a time to buy? If there was a time in the last 2 weeks where you're like, wow, I'd like to get in Sentinel One, but their stock has been up quite a bit, and I'll go back to the monthly chart, you're like, it was up a lot this last month. Now you get a 10% off discount if you're interested in buying its appropriate risk level for your portfolio. I left up on the screen, you can see the earnings for them. Sentinel One earnings do not come out until March 13th, but you can see their earnings is overall trending very well. They've moving into profitability, and this is just a great company. So why, how do we look at this when things go down? When do we buy? And Steve mentioned earlier, we were going to talk about the overall market and volatility and what I'm going to call intra-year volatility. And this slide is compliments from JP Morgan Asset Management, but a slide that as soon as I saw it, I really, really enjoyed looking at it. And the reason why is because it explains a lot of my feelings that I've had over the years. Sometimes in a year, my portfolio reaches X amount and then it drops 10%. And I think, oh, wow, I'm down 10%. How could that be? And what this shows you is that each year, the red dot is the lowest thing the S&P 500 dropped in that year. So you could take like last year, which was an outstanding year. There was a time last year where the S&P was down 10%. Now at the end of the year, the gray bar shows what it finished. So last year, the S&P 500 finished up 24%, but at one point it was down 10. Now some of the value that we bring is, how do we pick when we go into these places? How do we as professionals pick the times to buy when the markets are down? Can we get comfortable with doing that? And that's just a different way of looking at it, getting a good entry point in. So like, for example, a Sentinel One today, it's a good entry point. It seems it's because it's down 10%. Now at the end of the year, if the thing is up over 50%, the stock's up over 50% or whatever it ends up, this was a good time to get in. So, of note, if you look at this chart, you can notice that the majority of the time, the gray bar is up. In fact, it was up 33 out of 44 years. So I just know that for any of you out there that are thinking, boy, the stock market moves a lot, I'm not sure, when to get in. I'm not, I'm just going to sit and hold. There are times that it's good to get in, usually during these downturns. So that's all I have for now.
Yeah, you bet. And I think it's instructive of their, there's no crystal ball with investing, a lot like anything else in the world, but certainly investing, and things are on the move. But it starts like this. It helps you act with conviction during the times that it's selling off. It's just like, I don't know when the bottom is. I'm not trying to time the bottom of anything. That'd be nice, but not necessarily, I just want it. But if I know if I can get it cheaper today than I have been able to, and it's something that I want to buy for the portfolio, then certainly these dips are not necessarily a bad thing. So we'll see how it turns out for, the story of the day with Palo Alto and Sentinel One. But certainly I'm not worried about the entire investment thesis of, cybersecurity over time. And I'm not worried about the U.S. market over time because of, 33 of the last 44 years finished up there. So thanks for those insights, Mike. And thanks everybody for listening in. As a reminder, we did talk some individual stocks. You have to do your own due diligence before you act upon anything you hear in this presentation. With that, we will see you guys back tomorrow. You have a good one.